All right. Well, good morning. Thank you for taking the time today to join us. Our working group chair, Deputy Insurance Commissioner Brian Welch, is on assignment and in transit today, but he's able to join us in between flights and listen in. Therefore, I've been asked to welcome the group, provide some background for today's meeting. My name is David Fort. I serve as the Senior Policy Advisor for Property and Casualty Insurance at the Office of the Insurance Commissioner. And, when legislators came to Brian about a year ago regarding the difficulties permanent supportive housing providers were having with the current insurance market, we immediately recognize that this business operation is critical for how Washington State wants to address sensitive societal issues around housing, behavioral health, and the well-being of some of our most vulnerable people. Now, while those issues are outside our scope of knowledge, the insurance market is not. And the changing insurance market is making it very difficult for these business operations to function in the same manner that they were before the current hard market. Insurance is about financial resilience, and not being able to find the amount of coverage the housing providers needs threatens their financial resilience. And if they can find coverage, the cost of that coverage has become a burden to their budgets. So the legislature asked the insurance commissioner to look into the insurance issues and provide some ideas that may affect the levers of the insurance market. So the short time required to investigate these issues means we actually started the work once House Bill 2329 was proposed to the legislature. And we recognized the looking into the insurance issues with the housing providers, using the state's housing trust fund and serving extremely low income households, that we were going to need additional actuarial and policy team members. So after a national search of the most qualified and substantial firms across the country, Davies North America and Alvarez and Marcel Financial Services were selected to take on this challenge with us. And once they were retained, we all jumped into the work we knew needed to get done in a tight timeline. So the staff at the Office of the Insurance Commissioner is so thankful to Rebecca Freitag and her team for the eagerness, the professionalism, and the deep knowledge on insurance principles that made a report on these issues affecting the market even possible. And we're also very thankful to the members of the working group. You provided critical information and many, many hours of your time to speak with us individually. So today, we're going to hand it off to Rebecca and her team to take us through what they have learned in a series of policy ideas that could affect the insurance market. We are sure that there's going to be questions and comments, and we're going to have time to address those. So please feel free to type in chat if you have any. And at the appropriate times, we're going to pause and discuss them. So Rebecca, thank you so much. Take it away. Oh, can't hear you.
Can you hear me now?
Yep.
Okay, that was weird. Thank you. Let me share my screen. Okay, can you guys see my screen?
We sure can. Thank you.
Okay, terrific. David, thank you so much for that introduction. I had a whole list of things to talk about on this slide, but I don't need to anymore because David already covered them. But I will just say, this is our introductory slide. We are honored to have worked with the Office of the Insurance Commissioner on this really important study with David and his team, Brian. We are also really grateful to so many of you who are on the call today who took your time to talk with us, inform us, educate us, and so we could come in to this project, to the analysis of the data with a tremendous amount of knowledge based on research and also based on talking with all of you. So thank you so much. Okay, I'll just introduce all of us, all the people who will be presenting today, the team that worked on this report. My name is Rebecca Freitag. I work for Davies Actuarial Audit and Consulting, which is a part of the Davies Group, which is a global insurance services provider. I'm an actuary, and I am the actuarial lead of our regulatory group at Davies. My two colleagues, Greg Fano and Peter Skordas, are also actuaries, and the three of us have worked together for many years on a lot of different um, difficult market issues that have come up in the insurance space. I'd also like to introduce our partners, Doug Greer and Scott Harrison from the uh, insurance industry practice of Alvarez and Marcel, which is a consulting firm serving government agencies, nonprofits, operating companies, and investors globally. Okay, this is our presentation structure and estimated timing. We have a lot to get through. I hope we'll get through it all. What we're going to be presenting today is it's an abbreviated presentation of the draft report we've presented. Part of the reason for this presentation today is to get feedback and thoughts from all of you. But so just to give you an idea of what this is going to look like and when you can breathe, we're going to do kind of an executive summary intro for, I hope, the first 30 minutes. Then after that, we'll take some time to answer your questions. It is my hope that, you might have a lot of questions that come up. It is my hope that at least some of them will be answered during the course of the presentation. So in an effort to get through the material, we'll get through the introduction, the executive summary, we'll have a break for questions, and then we'll get through the detailed policy options, and then we'll have another longer session for questions and answers. And there will also be, we hope to cover as many questions as possible today, but there will also be an ability to send questions after the presentation if we can't get to your question. Okay. Oh, before I dive into the executive summary, I have to say on behalf of all the Davies folks, our power is out in our building today. So we're all presenting from home. So I hope we don't have any interruptions on the Davies side, but I hope you'll be generous with us if we do, because we couldn't help it. There was no power at the office. Okay, genesis and purpose of this market study. David really said it all, and he talked about how the legislature mandated this study. But just to kind of, again, set the landscape of what we're talking about, affordable housing providers receiving housing trust fund resources serve a critical role in meeting the housing needs of extremely low income households, right? And so just to reiterate, that was our scope. Our scope was about looking at availability and affordability of insurance for housing providers that are serving extremely low income households and that are receiving housing trust fund resources. That was our scope, and that's what we stuck to. As you all know, the United States Department of Housing and Urban Development defines extremely low income households as those earning 30% or less of the area median income. And then, of course, there's a subset of those extremely low income households which are designated or which are eligible for permanent supportive housing. And as we all know, permanent supportive housing very intentionally has low barriers to entry. So again, the scope was all extremely low income households, but certainly a large subset of that is the permanent supportive housing subset. Housing providers have recently reported serious challenges in securing property and liability insurance coverage at affordable rates. David mentioned that, and certainly we, at the first working group meeting, we listened to many of the housing providers talk about the very real challenges they're experiencing. And so the Office of the Insurance Commissioner retained our group to identify underlying causes and suggest policy options, and we are going to outline 12 policy options for you today. Okay. We want to talk, when we say that there are problems with affordability and availability of insurance in the housing provider market, and we're talking, the scope of the study was property and liability insurance specifically. There's all kinds of insurance you might have, but we're talking about the property and liability insurance for the housing providers. So what is happening to housing providers? Now, as I'll discuss in the next slide, we gathered this information from a bunch of different sources. What is happening to housing providers? There's pretty much 4 big categories of what housing providers are experiencing in their property and liability insurance. The first is that an insurance company may decline to renew a specific policy or they may leave the market altogether. So, it's coming up time for housing provider A's renewal, insurance renewal, and they're looking forward or maybe a little bit scared about what the renewal will be. And instead of hearing what the cost of the premium will be, their broker tells them, I'm so sorry, this insurance company or this pool or whatever is not going to be able to renew you this year. Sometimes that's just for that housing provider, or sometimes the company or pool has decided to pull out of the affordable housing market altogether for reasons we'll discuss a little bit later. So that's, of course, very unsettling and upsetting. That's one problem that has happened. A second problem is that the insurance company is happy to renew the insurance, but at a premium increase that the housing provider cannot afford. We're going to talk later in the presentation about, the general trends in the property market generally and the property market in Washington. Rates are going up all over the place, but the housing providers are really, really feeling the pain of some of these rate increases. And as we'll discuss later, rate increases are going up for housing providers more than they're going up for some other properties for reasons we'll discuss. The third thing that might happen is the housing providers might have less insurance coverage upon their renewal. There's a lot of different ways that can happen, but we'll talk about two major ways that can happen. And either of those ways can really be motivated either by the insurance company or by the housing provider themselves. So the two items that we've listed here, the first one is a higher deductible. So everybody's probably familiar with deductibles in your own personal life. You have an auto policy, you have physical damage coverage on your car in case it gets into a crash or is otherwise damaged. And maybe your deductible is $500 or $1,000, which means that if there's a crash and you submit a claim to your insurance company, you're responsible for the first $500 or $1,000 or whatever your deductible is. Housing providers also have deductibles on their property coverage. For a housing provider, it might be as low as $1,000, or it might be $10,000, or it might be $100,000 or more, depending on the size and profile of the housing provider. So what might happen at renewal is that the insurance company might say, we're happy to renew you, but we need your deductible to go up. So instead of a $5,000 deductible, this year you're going to have a $10,000 deductible. That can help the insurance company lower their risk a little bit, because if you have a lot of low value claims, then raising that deductible actually reduces the insurance company's risk. And when I say that's colloquial language. It's not really fair. Insurance companies determine risk based on the whole world of risks. So it's not only based on that housing provider. It may be that they've seen in general housing providers are having a lot of claims or whatever. We'll talk later about how pricing works. But anyway, so the insurance company might say, we're happy to insure you, but you need to have a higher deductible, or it might come from the housing provider or the broker. The housing provider might get the renewal and say, I can't afford this premium. And the broker will say, well, if we put you up to a higher deductible, then the premium will go down because the insurance company is taking less risk. So the housing provider might say, oh, okay, let's cross our fingers. I'll take the higher deductible and pay less monthly or annual premium, and I'll hope I don't have a lot of claims, right? So that might be motivated by the housing provider also. But either way, they have less coverage than they had the year before because they have this higher deductible, and when they make a claim, they're responsible to pay more of it. The other way they might have less coverage is if they have a lower limit or sublimits. So the insurance company might say, we can't insure this building this year for up to $10 million. We'll insure it for up to $8 million. Or the insurance company might say, there are a lot of water claims. And so we're going to put a sublimit on water claims. Your limit is whatever it is, $2 million, but we're only going to pay for $300,000 worth of water claims, whatever it is. Either one of those options, either a higher deductible or a lower limit or sublimits, reduces the coverage that the housing provider is obtaining. So those were the first three: declining to renew, premium increases, or a decrease in coverage. And the fourth option, or fourth, it's not an option. The fourth thing that's happening is that we have heard from some housing providers that they are just not reporting claims because they're so scared of either getting non-renewed or strong premium increases at renewal. So that might be not reporting claims under their deductible. It might be not reporting claims a certain threshold above their deductible. They'll just deal with it themselves and they'll pay for it from their operating budgets. So all are these are the key areas that we heard that housing providers are really struggling with. Okay, and so this is my last slide. In case you're tired of hearing from me, I'll pass it along to somebody else. But so now what did we do? The author's approach, what did we do? There was so much to learn. There was so much information to gather. So the first thing we did is we gathered information. We conducted numerous interviews with market participants to understand the issues, challenges, and potential policy options. And those market participants included so many people in this meeting today. They included housing providers, insurers, pools, insurance brokers, regulators, other government personnel, and legislators. We are so grateful to all of you for providing your time and insight to us. We also gathered data from housing providers through a voluntary survey. That was a terrific source of information. Thanks to everybody who responded. We heard about the challenges you're facing. We heard about some of the things that you're doing to try to lower your risk and lower your claims. We gathered housing providers' insurance experience, including premiums, exposures, like how many units they have, and claims, through a data call issued by the Office of the Insurance Commissioner. That data call was part of the legislature's directive to the OIC, and it was a very important part of this study, and is why we need the boring actuaries on the phone, myself included. I shouldn't say that Greg and Peter are boring. And we also conducted market research to understand the broader market conditions. So again, nothing happens in a vacuum. So we needed to understand, what is the global market in insurance? What is the property market in insurance nationwide? What is it like in Washington? We have to view everything in context. After we gathered that information, we synthesized and analyzed it. We conducted an actuarial analysis to understand the extent to which underlying claim costs are driving the insurance availability and affordability challenges. So when we look at the data, we find like, well, the pricing seems kind of reasonable, then that puts a different filter on our problem than it would otherwise, right? We still have a problem. It's still too expensive for the housing providers. But if we don't see anything that says the pricing is unreasonable, then we got to solve the problem in a different way than we would otherwise. We evaluated a bunch of options based on expected impact and availability and affordability of insurance. Again, availability means, can you get the insurance? And affordability means, can you pay for it? The cost, time required to implement, all kinds of other things. You know, we have 12 options. We probably started with 20. We whittled them down until we thought of 12 that seemed viable. They each have pros and cons, as we'll discuss openly later. It's just really a buffet for everybody to consider to try to find the best possible path forward. And we also considered each option's impact on the total cost of risk. So we like this term. We might have too many. We try to stay away from acronyms, but if we use this TCOR, total cost of risk acronym in our slides, what we're getting at is we need to look at the total cost to the housing providers. We need to look at the total cost to the insurance providers. We need to look at the total cost to everybody, right? So it's not just the cost of the premium. It's also the cost of the claims in the deductible layer. It's also the cost of the claims that are being retained because people are too afraid to report. It's also the cost, as we'll discuss later, to buy reinsurance. So if the insurance company can't handle a claim of that magnitude, they need to go out to bigger entities to get more coverage. So we need to think about options. We try to think about options that will minimize in the long run the total cost of risk. Some of our options do lessen the total cost of a risk. Some of them don't, and they just try to find ways to handle things in the short term. Anyway, with that, I'm going to turn it over to Peter.
Rebecca, thank you very much for setting that up. Throughout the presentation today, you will hear terms that may be new to you, that are everyday to the insurance professionals presenting today. Hopefully I can help guide you along in an intro here. Insurance providers sell policies to entities and individuals. These are the policyholders. There is no reduction to risk from an insurance policy. The insurance transaction transfers risk from policyholders to the insurance carrier. Policyholders pay premium to the reinsurer. The insurer provides a financial guarantee to provide the coverages outlined in the insurance policy. In the circumstances where a policyholder suffers financial harm from a covered event, they will submit a claim to their insurance company. Insurance companies administer a claim settlement process to match coverage from the policy with the event and circumstances of the claim submitted. Insurers will then make a payment to or on behalf of the policyholder per the insurance policy terms and conditions. Claims where payments are made by the insurance company, the amounts are termed insurance losses. Many insurance policies contain a deductible, as Rebecca mentioned. The deductible is typically a portion of the claim where the risk is maintained by the policyholder. The insurer will reduce the total amount of the claim by the deductible amount, if any, within the insurance policy. The insurance for the scope of this report are two key coverages: property insurance, which covers the physical damage to the property structures, locations, and liability insurance, which covers liabilities that arise from events that happen to persons and things other than the policyholder. Examples of this include a resident that is injured from a broken handrail or a slip and fall, or actions where the policyholder may be deemed negligent. You can go to the next slide. Thanks. So our premiums and rates. Insurance premiums are based on actual estimates of all future loss costs for providing in each individual risk. So what are the future costs? Well, the largest component of property and liability policies is losses. The losses are the expected amount of covered claims. To determine these future losses, we typically look to historical events that have occurred. We use these events and project the losses to anticipated values that will be paid in the future. We use loss trends to adjust the observed historical losses to reflect the costs and exposures in the policy period. Not all losses can be projected from past events, though. Some of the future and historical events are extremely random, and their future projection is not appropriately reflected by solely looking at past events. Catastrophic events can cause random losses that must be tempered when observed in the historical losses. And an appropriate loss provision must be included at a reasonable expectation of the probability for these unique events that will occur in the future. It is not a regular occurrence in Washington, but extreme weather and other events still occur that cause these types of losses. The next component is operating expenses. These are frictional costs related to an insurance policy. These include commissions for insurance agents, brokers, company salaries for underwriting, policy issuance, and claims administration. Insurance carriers have reinsurance costs. They will typically buy reinsurance to cover events that would cause a large strain on their capital from a single or multiple events. This coverage allows the insurance company to provide the comprehensive financial guarantee that is in the insurance policy. The difference between the reinsurance premium paid by the insurance carrier and the estimated losses that are covered in the reinsurance policy are referred to as the net cost of reinsurance. And this is included as a component in the policy premium. Cost of capital. Insurance companies require a significant amount of capital to provide the financial guarantees in the insurance policy. investors expect a return on that capital that it would find in other investments with comparable risk. Therefore, insurance carriers include a profit margin within their rates that is based on all the expected cash flows of the insurance policy and capital supporting the insurance policy to reach an expected rate of return. And that profit margin is then is concluded as a component of the rate. So this all leads to what should be stated here, which is one of the biggest challenges, is an insurance policy's price, the premium paid by the policyholder, must be set before the costs to issue that policy are known. So Rebecca touched on availability and affordability in some of the challenges that we reach now. So insurance companies price their business based off of things that have happened in the past to help them determine what's going to happen in the future. And most insurers are for-profit business that are regulated, and part of this regulation is to ensure that they remain financially solvent to pay their claims in the future and fulfill the financial guarantees within the policy. The rates set need to be reasonable. We determine that in the actuarial world by calling it not excessive, not inadequate, and not unfairly discriminatory to the policyholders. When insurance companies face challenges in determining what those future costs are going to be, that creates uncertainty in the market and can create volatility in pricing, and also create availability issues, and at times can lead to the carriers exiting the market. So some of the long-term methods to address availability and affordability, these can include, let's adjust the risk, fortify a location so that it makes it less resistant to losses that could occur in the future. Make the building stronger. Another element to reduce expected losses is to reduce the coverage limits for components of the property. Another area that sometimes takes place is modify the venue, the legal environment. It can change laws that can impact the ultimate settlement values of property and liability claims. These can help these adjustments can help to create a little bit more certain world as we move forward. Another area that can be reviewed is the insurer's expenses. Is the process operating in an efficient manner? Is the cost of reinsurance so prohibitive that's causing price increases? And ultimately, it comes down to combinations of above. Looking at various aspects, making the optimal choices on a going forward basis can assist in availability and affordability within the insurance marketplace, and specifically the marketplace subject to our report today. Ultimately, if insurance market cannot afford, if the insurance market can't reach an affordable market, government may become involved in the process and create a program or mechanism to insure the risk. This can solve the affordability problem. It could help in the availability, and depending on its structure, can be a potential solution. There are challenges. It can require capital up front. If the operating costs, losses, expenses are higher than premiums collected, it requires funding. It requires things to go forward. With that, I'm going to turn it over to Scott Harrison from Alvarez & Marsal.
Okay, thanks, Peter. Good afternoon. I'm part of the Alvarez & Marsal team. I'm going to focus a little bit just on the last concepts of insurance slide here, which involves really how the industry is regulated, and a little bit about the market segment, the property casualty market segment that's that is at play, here, in this project. And I just want to reinforce the role of the regulator here, and the you have a great insurance department in the state of Washington with a great history, very good regulatory background and experience and track record. But it's very difficult to be a regulator in a dysfunctional market. I've served as a regulator in New York in the past and dealt with dysfunctional markets. And the primary responsibility, I think, as Peter just mentioned, is the regulator is to regulate for solvency and to ensure that the carriers that are doing business in the state are going to be there and are going to be able to fulfill the contractual promise that they've made to their policyholders. That's ultimate consumer protection. When you have a dysfunctional market, there's this balancing that goes in. You want to attract companies to come to the market. You want them to stay in your market. They have to charge rates that are fair and reasonable and are high enough for them to be able to be solvent. And so it's a very difficult challenge that your regulator has in doing consumer protection around solvency and some of the other things when you've got some troubled markets, which we'll get to in a moment. So the other thing I want to cover quickly in the slide is to reinforce there are really two types of markets, as we refer to it, in the property casualty world. There's the standard or admitted market and the non-admitted market. The standard market is what you think of as the insurance companies, the name brand insurance companies you see advertising on television all the time. Everybody knows the names, they're household names. And these are companies that primarily sell personal lines insurance, homeowners, automobile insurance. And these companies do business within the state, in your state, on the basis where their rates are regulated. In some cases, they've got to file the background, for to justify their rates. And again, just to emphasize this, state law requires that insurance rates in your state not be excessive, inadequate, or unfairly discriminatory. That's sort of the statutory balancing act that goes in. And again, the idea is to ensure solvency. And companies are allowed to underwrite in personal lines. And underwriting really is the process of going through assessing a risk and assessing whether you want to take that risk on or not, and how that risk should be priced. You see the word discriminate here on the slide, and underwriting is a form of discrimination because it's choosing option A versus option B, or maybe not to insure option A at all. That's perfectly legal. It's lawful. What is unlawful in every state, including Washington, is unlawful discrimination. The other thing I want to cover here real quickly is the concept of the non-admitted market, which is very important to this project. And it's really important to understand because the rules that apply to non-admitted carriers are different than those that apply to admitted carriers. And really the market that we're talking about here for these properties is primarily evolved. It's become the non-admitted market. So in this case, examples of non-admitted markets can be risk pools, excess and surplus lines, carriers. But it's important to bear in mind here that those rates, the rates that those insurance companies charge, are not filed with the state insurance department. So their rates are not regulated. So there are reasons which we don't have time to go into today for why the excess and surplus lines market plays a really important role in the overall insurance scheme and economy. But for purposes of this discussion, it's important to bear in mind that really, for the most part, the carriers that are writing business in this space, they are not filing their rates with the insurance department. We can just move to the next slide. Thank you. So let's sort of switch gears a little bit here and move into our findings. And I'll cover the first slide here, then we'll move on. But really, this slide really addresses what's going on here in the marketplace. What's happening here? And there are three driving factors, here that are impacting insurance company behavior and pricing and availability. One is just the existence of the hard market for property insurance all around the country. Everybody knows it. You folks live out west where wildfire is a problem. Availability and affordability of homeowners insurance and commercial insurance is a problem because of wildfire. I live in the Southeast in a hurricane prone area, and it's the same where I live. And so we're just in a hard market. So you put some of these other factors aside, it's just a very difficult time for the property casualty insurance market globally, not just here in the United States. A lot of this has to do with rising inflation, cost of repairs, replacement of parts, replacement of anything that you have to rebuild costs a lot more than it did 3 to 5 years ago. That all has to be priced into the risk. So the other factor here is the types of properties that are involved. And what we found during this review was that many of the properties that are providing this housing to this population are older properties with wood construction, older roofs, and often lacking the sort of safety and mitigation measures that are found in new construction. So the bottom line is that the older properties, for these reasons, are going to tend to be higher risk than new construction with a lot of fire mitigation, water damage mitigation, other safety measures, built in. So, again, you see here that new properties and also that with appraised values of higher than 10 million, which is above the limit that many carriers will accept for a single risk. So you also have that factor as well. And finally there, real quickly, you just have the profile of the residents and just issues around the complexity of the residents that may drive behaviors that result in higher insurance claims. If we could just move on to the next slide. There you go.
Okay. The other component of what we did is we performed actuarial analysis of the data that we received. Now, as was discussed earlier, the data we received, the premium and loss information that we received primarily came from the insurance industry through a data call that the OIC issued and we were part of. As Peter touched on just a little bit ago, the purpose of actuarial science is to take a look at, analyze what's happened in the past and use that to predict what we think is going to happen in the future. So our goal with analyzing the data is to understand in greater depth what has been going on in this market and use that to predict, if no action is taken by the legislature, what we think is going to happen in the future. And once we have a good handle on that, then we can try to make recommendations or present options for what can be done to help change that path. So based on the analysis of the data that we reviewed, we saw no evidence that the current insurance rates are excessive from an actuarial point of view. So just to be clear, we're based on the definition that Peter was discussing earlier on how actuaries look at rate making. What we mean is the insurance companies are charging prices that are reasonable for the risk that they're taking on. Based on our review, we would estimate the annual insurable losses in this segment is somewhere between 10.8 and $14 million. This would be if you theoretically bought an insurance policy covering the entire market within scope and ground up, no deductible and no limit, we would estimate the annual losses on that policy will be between 10.8 to $14 million. That's based on an estimate of total cost per unit of $1,500 to $1,950 per unit. And there's around 7,200 units within the scope of our review. I will say this was an unusually difficult actuarial analysis to do. Actuarial analysis really heavily relies on having good, clean, accurate data. And there were numerous issues we had with the data in in throughout this review. So we wanted to highlight those just so that you could see what some of the difficulties are. First, we weren't able to get complete data for all insurers or all housing providers, mostly due to timing issues. The second is that insurance companies do not issue policies specific to extremely low income units or PSH units, permanent supportive housing. Instead, a housing provider buys a policy covering all of their buildings. They usually have some extremely low income, some residents that are in other classes of affordable housing. Sometimes those are within the same building even. So there's no way for the data to be split. Oh, here's the premium we're charging specifically for this building, this unit. That's just not how insurance companies look at this. We also weren't able to get any data on losses within the deductible because the data came from the insurance companies and they don't know what's not getting reported to them. And just the general issue that it's a small market. There's not that many units. 7,200 units is not that many to do a really credible actuarial analysis. The losses vary quite a bit year to year. There are multi-million-dollar claims in there that really swing the losses in there that really swing the overall results. I do want to be clear that none of the data issues are a result of anything the insurance companies or housing providers or anybody else did wrong. We believe that everybody in play, we were very happy with how easy they were to work with. Everybody put their best effort to give us the best information they had available to them. But there are many challenges in this market in getting this data in the first place. So that's kind of where the difficulties that we ran into. Now I'm gonna turn it over to Doug to do a brief overview of what we looked at for the policy options that we're going to present for the rest of the presentation.
Thank you, Greg. So everything that has been presented so far today has been context. And because the policy options that we're nearly ready to describe to you have to be evaluated within the context of the overall market, we just thought it's important that everybody has at least a base level of understanding of that. So with that, now there's three broad categories of things that could be done to impact the cost and availability of insurance. And this applies, broadly speaking, to almost any insurance market. Each of them has limitations, so the best solution will likely require a combination of these. So I'll take them in turn. The first of those is to reduce the total cost of risk. And as Rebecca explained earlier, the total cost of risk is the total cost of property and liability claims, regardless who pays for them. So it's not only the cost of insurance, it's the total cost of the damage. And reducing total cost of risk is the best way to reduce insurance costs over time. It can be done both by physical improvements to properties and by more effectively managing the behaviors of residents that lead to insurance claims. But one of the limitations of that is that insurers won't really give full credit for these types of initiatives until they actually see the results in the data. And that may take years. So it's not it's not likely to be an immediate benefit. The second category of the policy options involves creating a new entity, either a new reinsurer or a new insurer capitalized with public funds. And doing this has the potential to solve the availability problem, but it also has limitations. It doesn't change the total cost of risk at all, and it may not change the total cost of insurance premiums. And that sort of depends how you price it and whether or not you incorporate subsidies into the pricing of the public insurer or reinsurer. There are some circumstances under which the cost of premiums could actually be reduced without subsidies. So it certainly is possible, but certainly it's not a given. The third category is just a straight subsidy, right? This could be just done by, for example, just by paying the housing providers more. But of course, the primary limitation of subsidies is that it doesn't actually do anything to the total cost of risk. Also doesn't actually increase availability of insurance. And it could actually lead to disincentives to reduce costs, because if subsidies could reduce the incentive to mitigate risk. because if you don't have the cost, why invest the money to mitigate? So with that, combinations of those above options are likely to have the potential to solve both the acute problems in the market quickly in the near term, solve the availability problem, maybe some sort of subsidies could help with the immediate cost problem. And if you also couple those types of solutions with things that will reduce the total cost of risk in the long term, you should be reducing that risk and ultimately insurance costs, attracting new companies into the market over the long term. So some combination, again, to solve the near-term challenges while hopefully stabilizing the market in the long term. Okay, so now policy options. Here's a summary of the 12 options. I'm not going to get into the details in this slide because we're going to do that in the next section of the presentation. But I did want to at least orient everybody as to what we're going to cover. So notice there are 12 options. The check marks in the columns on the right show us that 7 of those options reduce the total cost of risk. 5 of them increase availability of insurance, and 8 of them either do include or may include some form of subsidy. And that's what the yellow check marks denote, that they may include it rather than they absolutely do. Now, the colors on the left of the chart show that there are some similarities in the types of solutions. So you can see that all of the yellow and orange boxes, for example, they're all public insurer or reinsurer options, and we've got 3 of those. You can see that the gray options are just straight out subsidies, and the blue options include some form of reductions to the total cost of risk. The green one at the bottom is the combination. Okay, so now on to potential funding options. Of course, any solution that involves any kind of subsidy needs to be paid for. And so determining how to do that is really not for us to decide, but we wanted to at least suggest a few possible alternatives. So the first of those is to allocate a portion of premium taxes. They're already being charged to insurance companies, and a portion of them could be earmarked to fund some portion of the solutions. Now, the small size of this market, again, 7,200 units, is pretty small, means that a relatively small percentage of that allocated premium could potentially fund a substantial portion of the solutions that we'll take you through in more detail in a few minutes. The second is through special surcharges on insurance policies, essentially fees. Now, generally, insurance companies can pass on surcharges and fees to policyholders, and they just increase the premium rates to recoup those. So it's a form of cost that ultimately falls back on the policyholder, but it may be spread more broadly to other types of policyholders depending on how it's structured. The third one is to increase the document recording fee that currently funds the housing trust funds that help to subsidize operating losses of housing providers. And so either additional fees or increasing that document fee could help to fund subsidies if the legislature thinks that's appropriate. And finally, just taking money from the general fund or levying other taxes or fees. But unfortunately, it needs to come either from additional fees, taxes, and the like, or by reducing spending somewhere else. Let's go to the next slide. Okay, so now we've got a little bit of time. We had asked David if he might take a look if there are questions coming in through the chat. We asked David to sort of curate those for us, and we thought we would pause and maybe we could take a few questions now if there are any. And after this, or if there are no questions, we'll go into a more detailed discussion of each of the policy options in a minute.
Yeah, thanks, Doug. We don't have any that have come up in chat, but if somebody wants to use the raise hand function down there at the bottom of your Zoom, please feel free to do so now. Otherwise, we'll get going to the 12 policy ideas. I'm not seeing any, so we're good to go.
Okay. As Doug just outlined, the first 3 policy options all involve some form of public insurance or reinsurance. It was really important to us that we present options to the legislature that are not intended to replace the current private insurance market, but are intended to supplement or stabilize the insurance market and really hopefully work to everybody's benefit ultimately work to everybody's benefit within the space. So the first option is a public reinsurer. Now, as Peter presented earlier, reinsurance is normally an essential component of insurance. An insurance company will agree to write a bunch of buildings, but normally they're not in a financial position to cover the losses if there's a bunch of losses on a bunch of different buildings in the same year. They're similar to a bank run. So they need to buy reinsurance to help them out. Hey, if a lot of losses come in that are more than we can actually afford to pay, the reinsurer will kick in and help us out pay those losses so that we retain our solvency. It's very important, especially for people that write high limits policies. These, there's a lot of very, very high cost buildings that are being insured here. The insurers absolutely need to be able to protect their solvency so that if there's a really large claim or a series of large claims, they are able to stay in business and pay the claims that they promised they were going to pay. But many of the insurance companies or people affiliated with insurance companies that we talked to highlighted that increasing reinsurance costs were a major part of why they were having to increase the primary insurance costs. So in some instances, the insurers are in the same boat as the housing providers. You have the reinsurers that are raising their premiums, and then they've still got to be able to collect the money, but they have the option to, so they're charging it back to the housing providers. Unfortunately for the housing providers, that's kind of where the ball stops. They have nobody to charge that back to, so that's why we're here. If a public reinsurer could be created that would help reinsure the commercial insurers' risks, that could help to stabilize the reinsurance costs and ultimately help to stabilize the primary insurance costs that the housing providers are paying. Reinsurers could subsidize the cost if they charge less than actuarially sound premiums, or they operate more efficiently than a private reinsurer, or if they're just able to charge a lower profit load. So one major consideration here is that reinsurance typically comes with a large profit and risk load. That's a big component of the rate for reinsurance. So if a public insurer is able to charge a lower or no profit/risk load, then they could come in with substantial savings relative to what a private reinsurer could offer. This has the potential to reduce reinsurance costs or at least stabilize reinsurance costs over time. And not only would that help the existing carriers, insurance companies, that may encourage additional insurance companies to enter the market, because I'm reasonably confident that there's a number of insurance companies that would otherwise be interested in this business that just don't want to get into the space because they're worried about the implications it might have on their reinsurance. If you operate a public reinsurer, the first issue is the private insurers may not buy reinsurance from the public reinsurer. They may not trust it. They may have reinsurance partners they like already. So you could either mandate that so that is a risk. The way to mitigate that risk is to make sure the reinsurance rates are attractive to the insurers, and to issue some kind of a mandate that a portion of the reinsurance savings be passed on to the policyholder. So what we don't want is the public reinsurer comes in with a lower rate than the private reinsurers did, and then the primary insurance companies keep their rates the same and just collect higher profits. We'd like to make sure that there's some mechanism by which that savings is in fact passed down to the policyholder, in this case, the housing providers. One problem is a public reinsurer would have to manage claims. So you would have to recruit experienced claim managers. You would have to outsource claims to TPAs. You would have to have some way of managing claims efficiently in order to operate a public reinsurer. May also have high claims. So either you could issue limits on the reinsurance costs, or on the reinsurance policy, you could structure the reinsurance policy to limit the exposure of state funds to the public reinsurer, or the public reinsurer could purchase its own reinsurance. you know, that is a problem, which is ultimately if there's a lot of losses that come in, somebody has to pay them. You can't avoid that. This would depend on also, there would have to be initial capitalization provided. So a specific block of money would have to be set aside to fund the reinsurer. And if the premium rates end up being lower than the losses, the reinsurer may also require ongoing funding. So that this could possibly be subsidized, but it's possible it could operate more efficiently than a private reinsurer, even without subsidies. You'd have to really get into the details to see how this would operate. And then we'll go to the next slide. So very similar. This is almost the opposite of that. This would create a public insurer that would insure small claims. I'll say quote unquote small claims. So let's say just for illustrative purposes, let's just say a public insurer was set up that covered claims with a limit of $100,000. Now every housing provider can purchase their primary insurance policies with a $100,000 deductible, and they've got a public insurer that is covering the first $100,000 of losses. So they have no more losses, quote unquote, within the deductible. Everything is covered by the public insurer, and then everything excess of what the public insurer is covering will be covered by their normal private insurance with an appropriate deductible. This would operate really similar to a reinsurer. You may notice that this slide is really similar to the previous slide because it's a very, very similar option. But it's just another way of going about the same thing. And then we can go to slide 3. The third is a deductible reimbursement fund. Now, this is very similar to the previous option in that we're looking at the first layer of claims. But you wouldn't necessarily, the difference is, it's critical to understand this difference because there's multiple different ways things like this can be set up. Policy option 2 envisions setting up a public insurance company. So a housing provider would pay premium for the year for the expected losses within the, let's say, $100,000 limit. And then the public insurer would pay out however many claims come in. It would operate just like any other insurance company. The alternative is you could just set up a fund. Here's a pool of money. And when you have a claim within your deductible, you can just go to the state and say, hey, look, I had a claim within my deductible. I had a $25,000 claim. I had to pay for this myself. And then the state will just reimburse you. So this is not a premium where you're paying for expected losses. This is a reimbursement where you're getting reimbursed for the losses that actually occurred within your deductible. This could be structured in a way that it allows housing providers to buy higher deductibles, which will help manage their budgets and may possibly help to stabilize their insurance costs over a long period of time. The problem is, of course, how would this be funded? So the first is this does not reduce the total cost of risk. This is just mostly just a subsidy. You're just paying back claims that occurred. The second is that housing providers may overuse this fund. So in order to stop housing providers to overuse the fund, you would have to set limits per housing provider on how much they were able to draw from the fund. And the problem is if the fund gets exhausted, then the housing providers are left with really high deductible policies and they can't afford to pay the deductibles anymore. So you need to be really careful to manage that possible risk, but it could be set up in a way that manage that risk. Oregon has implemented a plan that's somewhat similar to this. It's similar to this plus a policy option we have later that covers renters insurance, but that fund hasn't been implemented yet, or it hasn't started yet. It starts up soon. For all three of these options, if the legislature was interested in pursuing any of these three policy options, they would have to engage a separate study to work out the exact details of how these would operate. Within the scope and timing of our study, we weren't able to present an extremely detailed outline of how any of these would operate in terms of exactly what limits it should provide, what should the coverage terms look like, what premium should they charge. Those are all outside the scope of what we were able to do in the time frame we had. So a separate study would have to be engaged to look at that if any of these three policy options was considered desirable. Those are the three public option policy ones. We can go to the next one. Slide 4.
I think I'll take this one. Thank you, Greg. This slide, policy option 4, is about physical risk mitigation. In essence, what this is, it's encouraging additional risk mitigation by subsidizing the cost of physical mitigation. So this is devices that detect and stop water leaks, detect and suppress fires, and those kinds of things. The rationale for it is that the claim data shows that water and fire are the two largest causes of insured losses in this market, as they are, frankly, in all apartment buildings. And effective mitigation devices are available, but they cost money, and housing providers aren't flush with cash to install them. And so subsidizing the cost would enable them to be installed and would reduce the risk of sizable claims. Now, the cost range is pretty wide for these devices. Some of them are as inexpensive as $40 per apartment unit. Sprinkler systems could be many thousands of dollars to install retroactively into a building. So it's a wide range. There are many different types as well of these devices, everything from stovetop fire suppressors to auto shut-off devices on stovetops. They'll actually turn off the stove if it's left unattended for some period of time. Many different types of water detection and shut-off devices. Some of them simply detect if there's a leak on the floor and will trigger an alarm of some sort. Some of them actually will shut off the water, for example, in the event of a deep freeze. They may actually measure the temperature of the water going into the building. And in the event that they detect that it's about to freeze, they will shut off the water into the building in order to avoid the risk of having pipes burst and cause a lot of damage. We've got standpipe locks, which go into the essentially it's like a fire hydrant inside a building, and if they are accidentally or intentionally, in some cases, opened when they're not supposed to be, water shoots out of them, just like a fire department can cause tremendous damage. And of course, sprinkler systems. So a wide range of these types of devices with a wide range of cost. Some of them are not inexpensive, but if you think about the benefit of avoiding something that might be a $3 million claim from a fire or a major flood, after the fact, that feels like a pretty good investment. So that's the impact, right? Reducing the total cost of risk. Some carriers for some of these devices do offer premium discounts already, and some of the manufacturers of these devices advertise those carrier discounts on their websites. But for many of these devices, it's unclear to us what, if any, premium discounts carriers would offer immediately. It may, as with other mitigation offers or options rather, it may take time for them to show up in the data in the form of lower claims before you get credit. So that's one of the limitations. With that, let's go to the next slide. I think Rebecca was going to take this one.
Yeah, thanks, Doug. Okay, so Doug just talked about the policy option 4, which was physical risk mitigation. Policy option 5 relates to behavioral risk mitigation. So we know permanent supportive housing has low barriers to entry, and there is tremendous good that is accomplished with permanent supportive housing. Based on responses from housing providers, it does seem like once in a while there might be somebody that is in a housing unit where the housing provider is not equipped to sufficiently deal with the complexity that the person is presenting. Or sometimes a person might be in crisis and need an intervention and be able to effectively get that intervention for a short period of time to come back successfully to the housing unit. So we have heard from a number of housing providers that they would appreciate the ability to know a little bit more about some of their residents before they are placed, because of course, once a resident is placed, it's supposed to be permanent if they so desire. And we also have heard that there's sometimes logistical issues relocating a resident if that resident has caused harm to property or honestly to other residents. There may sometimes be challenges, logistical challenges in relocating that resident. And again, the third thing we heard is that there are challenges to getting a resident into some acute care, temporary acute care, because of the challenges of getting them back into that unit. So one thing the legislature might want to consider, one option, is are there ways that we can help the affordable housing providers to be able to either say, I don't think this resident is for me, given the information, I just don't think we're equipped, we don't have the services necessary, or to say, this resident has a history of damaging property or other people, how can we quickly get them into another state-run program that will help them get back to a better place? One issue that we heard again and again, and I already mentioned it, is that it can be challenging if a resident goes to an acute care facility for a short time. It can be challenging to get them back into the permanent supportive housing unit because the unit is not supposed to remain vacant, and also then they're not homeless anymore. So how do you get them back into the PSH unit? All of these issues are really like, I'm an actuary, and I don't have all the qualifications necessary to vet out all these issues, but we are hopeful that the legislature can, together with the housing providers, might be able to think of some strategies to help residents who are in need of acute care, and to be able to retain that unit for them so that they can come back when they're able to come back productively. And a couple of the, again, challenges and limitations. Obviously, permanent supportive housing is supposed to be a low barrier, so that would need to be very carefully considered. And also there are both funding and other issues with leaving a unit vacant, and those would need to be considered as well.
I think I'm up again for this one. Thank you, Rebecca. So on to option 6. This is a public renters insurer. And so renters insurance, for those who may not be familiar with it, typically covers 3, maybe 4 things. So damage to the renter's personal property is the first thing. The second is the cost of temporary housing if the renter cannot live in their unit during repairs. If there's a leak or fire and they can't live there, they need to live somewhere else. Third one, this is the important one for this particular context. It also covers personal liability if the tenant is found to be legally liable for damages either to the property or to another resident. And that last one's important because in addition to protecting the renter, it also protects the insurance company that covers the overall property. And that's because if a tenant causes damage to the building, the property insurer can then go and recoup a portion of those losses from the insurance company, the renter's insurer, that covers that resident for liability. Now, why is this important? It's important in this market in particular because the data suggests that 30% of all the insured losses are driven by tenant behaviors, as opposed to something like a weather event, for example. But because affordable housing residents don't have renter's insurance, the property insurer on the overall building cannot go anywhere to recoup any of those losses that it has to pay. So if they had renter's insurance, then the individual, if there was an individual responsible for the damages, would have insurance to help share the cost of the repairs, in effect, with the insurer on the overall property. Some of the challenges and limitations. For one, it doesn't really reduce risk. It just transfers a portion of the risk from the insurer on the overall property to the public insurer. So again, it's risk transfer, not risk reduction. And if the premium charged by the public insurer is actuarially sound, if it's sufficient to cover all the projected losses, it may be expensive. And it could be the case that residents and the housing providers may not be able to afford it. And on the flip side, if the premium is less than actuarially sufficient, in effect, that's a subsidy, right? And then the public insurer needs a source of ongoing funding in order to remain viable. So those are the challenges and limitations. Let's move on to the next one. I think Scott was going to take this.
Yep. Yeah, this one and the next one actually are, things that could be done. There's some challenges. One is, again, it goes to trying to mitigate risk. And with here building inspections, the recommendation or proposal would be to increase the frequency and scope of building inspections and appraisals, really focused on identifying risks and risk mitigation measures that could reduce insurance costs. And it's pretty obvious. The more comfort or knowledge the insurance carrier has about the condition of the building, risk mitigation features that exist in the building, the more likely they are to consider rating the risk and also price the risk more favorably to the property owner, because they won't feel like they need to make overly conservative assumptions because of not knowing what they don't know about the property. There's a reason that buildings are inspected, and a lot of that has to do with reducing the cost of insurance. And so this is a recommendation that we think could have some significant impact. A downside here is that the function of building inspections is handled on a municipal level and not by the state. So it's not clear to us what influence the state legislature could have in encouraging building inspections to take place on a local level. There is also a cost associated with these inspections, but as you see there at an estimated range of $120 to $230, that's relatively that's relatively modest. If we could move to the next slide, please. Okay, right. This is sort of related to the last one. Again, enhanced building codes. There's a reason we hit building codes, and insurance has a lot to do with that. Insurance companies, like the idea of having a uniform understanding of building standards in particular areas. And so a way to increase the insurability of property to lower the total cost of risk is to enhance your building codes. And, we think there are some things that could be done here really targeted at the types of property, the properties that are involved here to mitigate property damage and personal injuries, perhaps coupled with public funding to assist the housing providers to get up to code. Again, the rationale is pretty clear. The strong building codes lead to safer, more durable buildings, safer buildings, and lower insurance costs. The challenge is that obviously for existing properties, changes to building codes are typically applied on a go-forward basis or to new properties and are typically not grandfathered. So unless there was some exception made in changing the building codes to include existing properties, which frankly could be very expensive, the full impact of enhanced building codes would not take effect until the old housing stock had just been rotated out of use. We can move on to the next slide, next presentation. Back to Rebecca.
Rebecca, you're on mute.
Can you hear me now? Can you hear me now?
Yes, we can hear you now.
Yes,
Okay.
yes,
That was weird.
yes.
I had to turn the
Good.
mute off and on. Okay, thanks. So, policy option 9 is increased funding for social programs. Residents who suffer from mental health or substance abuse challenges may need ongoing counseling and medical support. If that support is unavailable, they pose a higher risk of damaging property or injuring, even potentially injuring other residents. So, honestly, permanent supportive housing is all of our housing providers are intending to provide those services, but many of them have said that they need more money in so many different ways. So providing increased funding for social programs may help also mitigate some of the risks of some resident caused behaviors. Of course, it will be necessary if the legislature wants to consider this option, it will be very necessary to work with housing providers to determine the appropriate services and the relevant costs. And the limitations is really our scope was supposed to be about insurance vehicles, insurance items. Of course, increasing funding for social programs helps in so many different ways. How this would tie back exactly to insurance costs would be very difficult to determine. Okay, policy option 10 is directly subsidize the cost of insurance. So we started right at the beginning saying that the housing providers can't afford their insurance. And we also have determined with our actuarial analysis that based on the limited data we have, the pricing does not look unreasonable. So one of the most obvious options, which is a short-term solution and doesn't really change the reality, but one of the options is to include additional subsidies to go towards that cost of insurance. So that subsidy could be directly for here's something to pay, here's some extra to pay your insurance premiums. That's part of your operational budget. It's a real part of your operational budget as these insurance premiums. Or, kind of something we've touched on before, the potential to subsidize risk mitigation measures. So some of those things that Doug talked about, standpipe lock or water detection systems, or all these things that would be helpful in mitigating the total claims cost. So this could be just subsidizing the cost of insurance directly probably doesn't help really the long term, potentially but it might be necessary so that housing providers can continue operating in the short term, and then maybe subsidizing the cost of some of the risk mitigation items is more of a longer term play. The cost for the proposal really depends on the amount of subsidy the state wishes to provide. So again, this was doing a detailed study of this was outside of our scope, both in terms of data and timing that was available to us. But using the numbers we had before, if the state wished to subsidize 20% of the total cost of risk, this would require additional funding of $2.7 to $3.5 million annually. That's, again, with all the caveats about the limitations on our data. Policy option 11 is a little different. A lot of what we've talked about has gone to the property side of the insurance market. We've touched a little bit on the liability side in terms of some things, some behavioral items that impact both property and liability. But policy option 11 really touches very much on the liability side of things. Sometimes in affordable housing, there are incidents that occur. There might be crimes or other liability type incidents that occur. And when those occur, those are of course tragic for everybody. But from an insurance perspective and from the perspective of the housing providers and then their insurance companies may be named in a lawsuit. So if somebody was injured on the site of a housing provider due to the behavior of a resident or a guest, the housing provider may be named in a lawsuit. And that, of course, is a risk to the housing provider. It's also a risk to their insurance provider. So there is precedent in Washington of creating an alternate negligence standard in certain situations where social welfare depends on people providing services. So for instance, there's a recently passed in Washington that, as you may know, emergency responders to different behavioral mental health crises may have a different standard of negligence as long as they have certain certifications and licenses to demonstrate that they can, in good faith, provide these services. So they might have, like, instead of the regular standard of negligence in court, they might have a standard of gross negligence or wanton or willful misconduct. Similar idea with some recently in the Washington State Legislature with burn bosses, that if people are certified to do a prescribed burn and then something goes awry, as long as they're certified and they've taken all the actions that they're supposed to take, then they can't be held liable because really just an accident occurred that was pretty much unavoidable. They could only be held liable in instances of gross negligence. So we did have this policy option that arose that perhaps to try to tamp down some of the liability costs for housing providers and their insurers, an alternate negligence standard could be enacted, wherein if a housing provider had certain training and certifications, they could not be named as easily in a suit. This is not a magic wand that would immediately reduce insurance costs, but once it was tested over time in the long term, it could reduce insurance costs and also reduce liability to the housing providers who are doing this very important work. Our last option is policy option number 12, which we've kind of alluded to implicitly as we've talked through some of our other options, which is a combination of options. And this might be the best way to go. Doug alluded to that with his great table with all the different colors in it. In a perfect world, if we could get it off the ground, it seems like a great policy option to consider would be something that both alleviated the short-term crisis and laid the groundwork for a longer-term solution. So, for instance, if the legislature chose to think about establishing a public insurer or reinsurer of some kind, they could also, that would help the availability issue. Then they could also mandate rate credits, which would help the affordability issue for certain risk mitigation measures, which should lower the total cost of risk over time. So in a perfect world, if we get all the stars align and we get their policy options when combined produce the best short-term results so that housing providers can continue to do their work and afford to do the work, and also long-term results to reduce the total cost of risk over time and create a healthier environment for insurance and for the housing providers. We're pretty much on time, I think. That is the end of our formal presentation, but at this point, we'd love to take any questions.
Okay, great. Well, thank you so much. We do have a few questions for the group. Go ahead and start populating if you have any more. Before we get to the questions, there was a comment in chat from Shannon Stuber relating a little bit about what the last policy option talked about, but directly with the reimbursement policy option, that it'll probably have downstream effects of freeing up funds for mitigation efforts. So thank you, Shannon, for the comment. We have a great question. Bill Gregory talks about most lenders and creditors require a certain type of financial rating for reinsurance towers. And so any thoughts on how a potential lender could view a public reinsurer? I don't even
It's definitely one of the most complicated issues as it relates to a public reinsurance option.
Yep.
And this is part of what I very briefly alluded to, that the devil's in the details on a lot of these options, but especially those first three that I presented, the public insurer and reinsurer. They're highly complex. And if a public reinsurer was set up, it's good to highlight, it would be critical to work directly with the insurance companies to make sure that the reinsurance that was on offer is actually reinsurance that they can purchase. So certainly, if the reinsurer was backstopped with some amount of general funds, or if there were other kind of guarantees in place that could get around bank or lender requirements, or working directly with the banks and lenders to figure out how we can get the reinsurance in place that will satisfy their needs. There are ways it can be done, but it's definitely Not, it's not a question that I can answer in this call. It would have to be a full-blown alternate study to figure out the best way to set up a plan like that.
Yep, with different interested parties and a lot of in-depth conversations about how to accomplish that. But right. Okay, another question. Were any of these conversations started with HTF? I'm thinking that's the Housing Trust Fund, WSHFC, I believe that's Washington State Housing Finance Commission, legislative reps on the options being discussed. We definitely had lots of discussions with Department of Commerce with the Housing Trust Fund, but no, this was our assignment to begin these types of discussions. So today is the beginning of bridging that kind of conversation of where these things can come from. And Jeff, do you have any follow-up questions? If you do, feel free to unmute and let us know your thoughts.
No, I was just curious about where you were at in the process and whether or not, there's some political issues involved, especially with document recording fees and being able to attach anything to those or increasing those. So I just wondered where we were at with that process and kind of what the landscape looked like in terms of commerce, maybe even having discussions about those.
Yep. First step. Definitely had lots of conversations with Commerce. They were a part of the working group. And the Housing Finance Commission were not. I know they do a lot with home ownership and those type of things. But we did not speak to them about housing providers. So this is the first step. And if more work likely needs to be done, hopefully we've provided a document to begin the conversation on how to affect the insurance markets. There's a lot of things in this space that overlap and are outside our expertise. As Rebecca talked about, the behavioral health stuff, the state has done a tremendous amount of work going forward in that area, we're just looking at the very narrow impact of how insurance reacts to it. So this is a big, wide conversation that needs to take place. We're hoping to provide a very narrow piece of the insurance levers and implications and consequences.
Let me say that in general, from our standpoint, the funding options that we presented, we're not experts in sound tax policy. We're not lawyers, we're actuaries. We're coming at this from our standpoint. And the reason we've even presented funding options at all is we don't want any involved parties to make the leap that subsidy means we're pulling money out of general funds. We just want to get everybody's mind thinking that there are many ways a subsidy could be funded that make sense, that are smart, that are not requiring additional financial burdens on the housing providers that can't afford additional financial burdens, or the residents who certainly can't either, or the insurance companies who are also in a similar spot. That there are many options for how any of these could be funded. We're not necessarily saying here's how you should increase the document recording fee, or here's all the implications of that. Certainly that's all you get out of our depth pretty quickly, but we at least wanted to get the gears turning, that there's many options for how this can be done.
Yeah, thanks, Greg. Another question is there any indication that HUD understands this insurance challenge and may be willing to loosen up coordinated entry requirements for permanent supportive housing to help providers mitigate these risks? I am not aware of what HUD knows or doesn't know about this issues.
No, we didn't talk to HUD at all. I will say this is an issue that many different states are running into. We have talked to multiple other states that are dealing with a similar issue. It's not an issue that is specific to Washington. So it is possible some kind of multi-state coordinated effort could make a headwind in that regard, but we didn't look at that. We were really focused just on Washington.
And I'll speak up. I have had a couple conversations with HUD, so they are well aware of the challenges.
Bill, can you introduce yourself to anybody?
Oh, sorry about that. I'm Bill Gregory. I'm the Executive Director of the Housing Authority's Risk Retention Pool and the Affordable Housing Risk Pool. Based in Vancouver, Washington, we provide property and casualty coverages for public housing authorities, low-income tax credits, and nonprofit housing. So there's a very, very small part of your 7,200 that actually fall in our pool, but it was probably about 3 months ago. I had a conversation with a couple of the representatives at HUD. They are well aware of the problem.
Great, good. Thank you, Bill, for
Oh, no problem.
making them aware. Let's see, do we have any other comments or questions? Okay. Well, not seeing any. I want to thank the working group again for your time and commitment to these issues, for the discussions and comments and questions today. Rebecca's team has a really tight deadline to finalize their report in just the next 2 weeks. Then the report will go through an internal process to make it available to the legislature before its due date in December. All work group members and interested parties are going to be notified when it's transmitted, and so you all have first crack of the copy of the report at the same time that the legislature will be receiving it. And I really just want to thank everybody again for your willingness to help this work get completed. And if you have any questions, comments, please feel free to reach out to me directly. I can put my email in chat real quick if you don't have it. And there you go. And if there's anything else that we can do, please reach out, and hope everybody has a good week. Take care.